Show is your Monday edition. I received a bunch of emails and messages over the weekend regarding different topics you want to see, so I'll let you know more about that as we progress through today's show. Today's show is going to be driven exclusively by a viewer question from Ricardo, actually, talking about retirements and protection on his account, so I thought let's just make a show out of that one. For those of you who don't know, Bill Addis will be on the program tomorrow. I had a request to do a specific show, kind of a crypto update, if you will, and I may do that maybe Wednesday or Thursday. Friday, we'll do our typical roundup show. I hope that you guys enjoyed the little session I did with Don Fran on Friday. You can find that over his YouTube channel, which is the Don Fran Show. Talked about all things kind of trading related, just an off-the-cuff conversation, which I thought was a lot of fun. So let me get started here today, and then we'll go into the overall markets, and then I'll talk to you about the one trade that I made today, and up to speed my Fortinet there. So the discussion really is going to revolve around the FDIC and the SIPC and who protects your money. So the question that I received was this one from Ricardo. He says, I currently have a 401k and at some point I plan to move it to an IRA. The issue is that nowadays there are so many brokers, so I'm a bit concerned where to open my future account. I really like TradeStation, but I find them to be a bit expensive compared to all the other newbies. But at the same time, how safe are relatively new brokers? Okay, so I'm going to start there, and then we'll dive into the weeds with regards to SIPC and FDIC insurance, which I'm sure all of you will want to know. Well, in regards to where you should open your IRA account. So one great thing about that is if you're in a 401k plan right now, most likely it's not self-directed. I know there are a lot of employers that will allow you to self-direct, but they don't voluntarily let you do that. You have to go to your HR department, and you have to ask to fill out a form, and you fill out this form, and then maybe if they allow it, you can self-direct. Those who may be new, let me explain what self-directing is. With your work employer's 401k program, typically a company comes to your business and says, hey, we will start a 401k plan for your employee. Employer says, okay, that's a good benefit for my employees. Let's do it. The company that comes and solicits that is now in charge of everything. What they typically will do is they give you a basket of mutual funds to choose from. Anything on this program over the past, well, I guess 14 years now that I've been doing this in Power Trading Radio, last thing you want to be investing in is mutual funds if you can avoid it. Mutual funds are typically high fees. They get you with what's called B1 administration fee. They get you with front-end loads, back-end loads, and all kinds of fees on top of fees that you don't even know. Pretty soon you're like, wait a minute, Mark was up 10%, but my fund only was up 6%. Yeah, that's the nature of a mutual fund. So that's the whole, and plus you're paying a management fee to be in that 401k, and there's all kinds of fees on top of the fees you had fees on and fees. So 401ks are great, really, in my mind, only if your employer matches. If your employer does not match, then you really need to reconsider, like, why are you in a 401k plan? Unless there's some tax benefit for you, talk to your CPA about that. Okay, so you've got these, Margaret says mutual funds, end-of-day purchase only, right? And even then, it depends on how that order is transmitted to your fund manager, because you might not get out of that trade for a couple of days later, right? There's a latency there. So if you're in a 401k, you're kind of handcuffed. You don't have active management of your trade. You can't really do much. You have no ETF selection. You can't pick individual securities. There's no options, no futures, no nothing. It's just mutual funds or a money market account, and good luck with that one. Hope you get matching. So Ricardo's doing the right thing, saying, hey, I want to get out of that 401k and go self-directed. Now, let's be clear here. There's a whole new set of risks that's opened up once you self-direct, because now you are in charge more so than you were with the 401k. The 401k, it's all long bias, meaning these are all designed to go up over time. So you put in money on the every paycheck you get, and you build up over time a nice account. So that you're kind of long-term bias, which is good because markets go up over time. In this case, once you go to the IRA, not only are you responsible for every single thing that you do, but it now opens the door to you potentially going short some of these markets, right? There are inverse ETFs that you could buy. Now, granted, you get better selection assets to choose from, ETFs being one of those. We could buy a mutual fund, which trades at the end of day only, or I can buy an ETF, which I can trade just like a stock, and they both represent the same basket of securities, and the ETF is much cheaper. So certainly want to go with the ETFs. Now, I know I'm kind of ranting on this one, but I guess Ricardo's question is, where should you open up that IRA account? I personally would say go with any of the big houses. Ameritrade, E-Trade, Schwab. Right? TradeStation, they're going to charge you a bunch of fees just to use their software, right? TradeStation software, they like to just keep charging you a monthly fee unless you're active on that. Now, I think they may have stopped doing that, but I stopped using TradeStation a couple years back because it's pretty complex. I would say for Ricardo, anybody who's thinking about self-directing their IRAs, you want to really look at what do you hope to do, right? Are you going to be now selling options for premium? Okay, it should have a better options program. Maybe you want to go towards the Thinkorswim platform at TD Ameritrade or Charles Schwab. If it's just buy and sell stocks, then cares? They're all going to be pretty much the same. Nobody charges commissions for stocks anymore, so you're pretty safe at going with the E-Trade, Ameritrade. You go interactive brokers, although I'll say interactive brokers, while it's cheaper, I don't like their platform as much. I find their platform rather clunky, and also the login process is a bit complicated with their business card with all the codes on it. It's kind of annoying. Yep. TD Ameritrade is now Charles Schwab. Yep. They merged. I still say Ameritrade, and I still say Thinkorswim, like they're separate entities, but you're right, they're all under one umbrella now. So, Ricardo, that's the easy step. Now, your second part of this is how safe are they? That's an area that you should certainly pay a lot more attention to. So, I had a couple questions here that you asked. Let me real quickly do here, so I can get these questions all in an orderly fashion. And again, everyone's going to be different with regards to what they need from their brokerage firms and how they need all this information. So take this as not financial advice. I'm just kind of pointing out what you need to look for, or what you should look for if you are opening up a new brokerage account. So his first question was, if all big known brokers are SIPC insured or any other type of insurance for those types of retirement accounts. Not all brokerage firms are registered with SIPC or FDIC. That's a huge factor. That's why I encourage everyone to stay with the big guys. I was on a call. One of the guys from OTA was talking to a student, and he had an issue, and they called me on the phone and said, hey, can you help him out here, and let's get some clarity on it. Now, this was crypto related. What happens is, a lot of times, especially in the crypto world, people will look at a brokerage account or a company and say, hey, this looks great. They're promising me X amount of rates of return. I'm going to make so much money. And next thing you know, those people will go over there and open up an account without checking to see if there's any protection. In this case, this company was out of Singapore. In my opinion, it's an absolute scam, right? If you're sticking with TradeStation, sticking with Thinkorswim, Ameritrade, Schwab, same company, E-Trade, Fidelity, those firms are going to be SIPC protected, and they're also right on their front page. They say it. Now, let's be honest. You and I know very well that anybody could put SIPC protected. So, if you are going with a broker that you're not quite sure about, it's not one of the big dogs, and like, hey, they sound good, I like the service, whatever the reasons are, don't go to their website to see if they're SIPC protected. Go to the agencies, go to FINRA, go to SIPC, go to the FDIC, and see, are those businesses a part of that network or a part of that system? If they're not, run away, screaming and kicking and screaming, right? Believe it or not. Yeah, markets, they did buy E-Trade, but it still goes under the E-Trade name. Actually, was it Morgan Stanley? Was it JP? Yeah, I think it was Morgan Stanley. I think it was JP Morgan, but you might be right with that one. So I'll get to that in just a second, Margaret. I'll tell you all about the coverages here because I want to go over the high level about it, and then I'm going to go through step by step exactly what they cover so you guys know how it's. So yes, most should be SIPC. I'll explain what SIPC is in a second. Most are going to be part of FDIC as well. All right. So second point of this one was, does the SIPC protect brokerage accounts of each customer up to $500,000? And I'm actually going to have this one. Here is kind of a representation of what it might look like with regards to types of protection, right? So you've got client assets in there, and typically if they're handling cash deposits, you'll have FDIC protection. So if they're doing CD products, if they're doing money market funds, those will typically be FDIC. I'll talk more about that in a second. So you've got that layer of protection for your cash deposits. The SIPC coverage goes deeper, but it's predominantly securities. Right? So it's going to be covering securities up to $500,000, and I'll explain more details in a second. Some companies, right? Some companies can get an excess SIPC coverage. So they'll get more than normal to make their customers feel a little bit more safe and warm and fuzzy. Now, you have to check and make sure how that coverage is set up and everything. And then the ultimate level of protection is obviously going to be regulators and regulatory oversight. The ones we're focusing on right here is these two in the middle, SIPC coverage and the FDIC insurance. So here is the FDIC. Let's start there with just the cash side of things. So the FDIC stands for the Federal Deposit Insurance Corporation, and insures deposits up to $250,000 per account. That's why I always say if you have like $1 million, split it up into 4 separate accounts, different brokerages. You can actually keep them at the same brokerage. It's just different accounts. So you have to have a separate account for each one. Let's see. They say, Lisa, by the question. Oh, okay. So here's how it breaks down with regards to what they protect you for and what they do not. So FDIC protects your investments if they're checking and savings accounts, right? So if you have a checking and savings account, I've got some at Schwab. Still haven't done my Ally or SoFi switch yet. I'm just totally lagging on that one. I don't know why. I'm an idiot. But those typically savings and checking accounts are FDIC protected. That's why when this whole financial crisis happened several months back, a lot of people were going, it's okay. I don't have over $250,000. I'm protected. Now, if you have $300,000, you might lose that extra 50. It could disappear, which again is why it's so critical to have separate accounts. Don't let anything go over those amounts. And I would spread them around at different banks. If you happen to have a lot of money, I would do that. And I know there were some comments that came through last time we had this discussion talking about, if it's a 401k, what's covered. I'll go through what I think I know about that. So here's what they continue to cover. You have checking savings accounts, money market accounts, cashier's checks and money orders was an interesting one, and then CDs. For those of you in certificates of deposit, those are going to be FDIC protected. So we were a couple days ago talking about having a large amount of money in a CD. Well, that one's protected because the CD is under $250,000. You're good to go there. What don't they protect you against? Well, if it's any kind of security, if it's a stock, a bond investment, they don't protect you against anything there. Mutual funds, annuities, life insurance policies, municipal securities, government bonds, none of that is covered under FDIC. So I simplify it when I explain it to you guys. I say it's just cash deposits, right? It's just money, checking and savings account. That's pretty much all that FDIC is going to cover. All right, so that's the easy one. I think most of you know FDIC, again, up to $250,000 per account. This one is a little bigger. The Securities Investor Protection Corporation, right? That's the SIPC, protects customers if their brokerage firm fails. Let me make this clear. It's not if you make a bad investment. It's only if the brokerage firm fails. So let's say Ricardo moves his money from that 401k to an IRA at E-Trade. For some reason, E-Trade fails, goes out of business. It'll now go through a process, and this could be a long time. You're wondering, how long does it take for me to get my investments out? Right? And we'll use Ricardo as an example. Let's say he's got $200,000 in a 401k. He moves that over to an IRA, makes a couple of trades. He's got a couple positions open right now, but all of a sudden E-Trade says we're going under. It's like, and he's freaking out. Well, you shouldn't freak out because you're protected up to $500,000 per user per account. So your money's safe. It's just a question of how long does it take for you to get it. Now, what typically will happen is a company like E-Trade would have to go through a distribution process, right? First off, they have to find a buyer for the assets of this brokerage firm, if there is one, or they start selling off parts of that brokerage firm because they can't pay you all the money they owe you without settling that estate first or settling that business. So they settle that business, which could take a while. Then, from my understanding, it should take between 1 and 3 months. Once they've found a buyer and they know what they're doing with all the assets and all the numbers lined up, then they can go out and pay you. So, it could take anywhere, let's say 6 months to a year till you actually get your investments or money back. And granted, over the course of that time, a lot could happen. So while it sucks that you're locked up and kind of holding these investments that you may not want to be holding that long, good news is you're going to get your cash back at the end of it as long as it's under $500,000. So here's what they cover. So I did this one just to be clear. The Securities Investor Protection Corporation, or SIPC, covers $500,000, but $250,000 of which may be cash. Of course, I spelled it wrong there. Apologize. I was typing quickly today. That's what I get for moving fast. And I want that to be clear that this will be part of that FDIC, right? So if you have an account for $500,000 and there's like $250,000 in cash in there, that's actually going to be part of your FDIC. That will be bundled in there. It's like layered. So it's not $500,000 of securities and then another $250,000 of cash. It's $500,000 total of securities or whatever, including cash up to $250,000. A little confusing there the way they do that one with the SIPC, but that's the rule. So here's how it breaks down. SIP covers your protections if your brokerage firm is an SIPC member. So again, I think it's really critical for all of you to check. Now, if it's, again, most of you have a Thinkorswim account, TD Ameritrade, Schwab, E-Trade, Fidelity, they're all SIPC. I checked E-Trade and Ameritrade when I opened up my accounts there, even though I knew they would be because they're just so big. There's no way they could skirt under the radar of regulators without getting that protection. But not all will be SIPC protected. Please check. Don't get hosed. Don't fall for who's a small mom and pop organization. Look, with this type of stuff, you go with the big guys. There's generally benefits to using such a big firm. You generally get better resources, better investment analyst tools. So go with the big firms. So if they're a SIPC member, you get protection under the SIPC. If you have securities at your brokerage firm, so you got some E-Trade shares sitting over at Ameritrade, they'll still honor it. If you have cash at your brokerage firms to buy securities, right? So sometimes we're not putting all of our capital to use. Right now, I'm looking for some opportunities since most of my options expired worthless and shares were taken away from me on Friday. I've got some cash sitting there right now, and that is technically going to be protected under the SIPC up to $250,000. No problem, Ricardo. It really is. I mean, I think in anything in life, we should all look. I'm taking a step back from trading and investing here, but in anything in life, I think you need to go through it looking at, okay, well, here's the rewards for me to do this, but what are the risks, and are there protections that might mitigate some of that risk that I'm getting into? If you are into skydiving, well, how do you mitigate that risk? Got a parachute. How do you mitigate it even more? Buy yourself a backup parachute. How do you mitigate even more? Well, you buy life insurance for your family just in case the second parachute doesn't open. But there's layers of protection that you can put on things to make yourself feel better about making those. All right. I keep putting Jerry Baldwin on there. All right, what do they not protect you against? They don't protect you against losses due to a decline in value of your security. So you lost 50% on an Apple trade. Yeah, that doesn't matter. They're not going to do anything there. Does FDIC pay out often, or do bigger banks just take over the troubled bank with some FDIC help? So I've never actually been involved in one of those, Tom. That's a great question. From my experience and just what I witnessed, not just in this financial crisis, but what I saw in 2007 and also back in 2000 when we had, failures going on all the time, typically the money stays in that account, the bank will get sold, and then your assets are still there. The account's just transferred over. You'll get some new stationery, some new checks with a new bank name on it, but your funds are all safe in there. Now, what I don't know personally, because this will, knock on wood, never happen to me, is I'm never going to have $3 million sitting in an account that's FDIC protected and, only covered up to 250. Now, in that situation, I'm not sure how that works. Does that move over to the new brokerage firm or bank and $2.75 million disappear and I just have my 250? That I don't know. I can't answer that, and I hope to never be able to answer it with fact from my experience. But yeah, I had a Washington Mutual account, but yeah, I actually did have a Washington Mutual account, and that was a seamless one. It just went straight over to JP Chase when they bought the assets in 2008. So that was seamless to me. And I remember at the time I didn't have a lot there. I was probably like 20 or 10. And I was kind of freaking out because I was like, what's happening to my money? And in hindsight, as I think about it, it really was a seamless process. I remember getting an email from, I think I got a letter from Washington Mutual explaining the process, saying all accounts are fine under $250,000. Your money will be moving over to JP Chase. You'll be receiving documentation from that. And then my statements just automatically became JP Chase. So now that I recall, I actually have been in one of the processes. I'm sure some of you have as well. I mean, if you had a Washington Mutual account or a Wachovia account back in 2008, you all have experienced that transfer. Just transferred that over. So I have a Chase account that was a Washington Mutual that had been savings, still the same PIN number. It was pretty seamless though, right? The only thing I couldn't answer you for there, Tom, is what's it like if you were over the 250,000 threshold? That I don't know. Which is why don't ever put yourself in that position. You got $500,000, 2 separate accounts, 2 different account numbers. Split that up. Do not keep it all in one account. And I don't understand why someone would want to do Why would you want to keep $1 million in one account? Maybe it just looks better on paper. Like, I have $1 million in one account. Who cares? I'd rather have 10 accounts with $100,000 and I'm spreading my risk around. Just today started getting served digital ads that claim that Charles Schwab and TD are committed to keeping the Thinkorswim as the platform. I certainly hope so. You know, Charles Schwab bought one of the greatest trading platforms in the history of short-term trading. So back in 2008, there was a platform called CyberTrader. Loved it. Not only was it a great platform, easy to use, very simple in its framework, but powerful, but it also had a development team on the back end. And because on the trading floor days I was so active, we would literally get on the phone with developers after the trading day and be like, hey, you know, we'd really like to see this feature put in, and could you do this and this? And, you know, a week or two later, they'd update the software and those new features would be in there. Good luck getting anything like that done today because of the scale of some of these big corporations. But CyberTrader was sold to Charles Schwab. Charles Schwab used it for a couple months, and then it just disappeared. They literally ruined one of the greatest trading platforms in the history of markets. So I'm nervous that since Schwab is now with, Thinkorswim is now Schwab's platform, I hope they don't butcher it like they did in the past. Their track record is not really good, in my opinion. Doing good. Bank of Wachovia when they were taken over by Wells. Totally seamless. They even kept the same account numbers, but I did need to buy new checks. They should have given you new checks, right? Yeah, cool. I'm glad you said that because those are the two big bank failures that happened then. Yeah, I don't think there'll be any real issue at all. Now, the question is that we didn't get to answer is, you know, Les and Tom and I both had, or all three of us had accounts. What would have happened if Wachovia or Washington Mutual couldn't find a buyer and nobody wanted to buy those banks? Then I don't know what would have happened. We probably would have gone through the liquidation process where they would have said, okay, the FDIC probably would have come in there and made all those accounts whole to pay us out, but only after they sold off all the assets of those banks, and that could have taken months to do. I called them recently and they said that there were no plans to change Thinkorswim. Yeah, pretty sure they're not going to, I don't think they're going to be like, yeah, we're scrapping it, right? Right now they're checking to see. It would be foolish of them to do away with Thinkorswim. But remember, there's logistics of managing so many different platforms. That's part of one of the issues for Charles Schwab is you have all these different platforms. Which ones do you keep? And that's probably why they killed CyberTrader. Felt that the average person wasn't doing a lot of short-term day trading, which CyberTrader was. Let's see what else I got. Seamless, yes, we were raising 2 kids, so $25,000 supporting OSA. Let's see. I have Thinkorswim, and they said they will be totally left alone as a platform. I hope so. I certainly hope so, because from an options trading perspective, it's the best out there right now. All right, let me finish this little piece here, and we'll move on. I have another question I want to make sure I get to today, and then I'll look at some markets here. So SIPC does not protect you if there's promises of investment performance. And you guys are all smart enough to know if someone's promising you investment performance, you should run away. Anybody who's promising X amount rate of return is most likely. And it does not cover commodities or futures contracts. Throwing that out there because I think some of you might be like, well, hey, wait, does that cover securities? Nope. SIPC does not cover futures or commodities contracts. So, you know, that's one other area of concern for some of you might be if you're with like MF Global. Right? When MF Global went under, they were the big futures platform out there at the time. What happened? What happens to all those people who are holding futures products? Is there any insurance for them? Not from the SIPC or the FDIC. What about OTA trade? You know, we put a lot of time and effort into the click options side of things, and I was kind of hoping that would have been rolled out, but the cost to create a brand new platform from scratch when you're somebody as big as Charles Schwab or you're somebody as big as E-Trade or Merrill Lynch or JP Morgan, creating a platform from scratch is a drop in the bucket. Smaller company trying to build it from scratch, it's a monumental endeavor, and yeah, cost became an issue there, so hopefully that will continue at some point. But does SIPC no. So we talked about earlier, does SIPC cover money market funds? No, that's covered under covered under FDIC. So you can see here, I got the graphic up there. The FDIC will protect you under money market accounts. So that would be $250,000 there. You don't put any money into OTA trade. Correct. Well, that's going to be some development pieces, integration, but so I think I got most of the stuff I wanted to cover here. I talked about SIPC, what they cover. I talked about the FDIC, what they cover. And I'm hoping there's a little more clarity there. There is one interesting thing. I want to make sure I get this one in my own mind down right. It was a weird little piece that I had to check out, and I double checked it. Wait a minute, that sounded really weird the way they wrote it. If it's SIPC, I believe you're insured up to $500,000. However, if it's a joint account, the same broker, SIPC, I believe gives you $500,000 per person. So that's something that could be very important for some of you that may have a larger account and, you know, concerned that you got $1 million account because it's with you and your spouse. I believe SIPC, it's $500,000 per person. There you could have $1 million account there and covered under SIPC. It doesn't do that with FDIC, but it does it with SIPC. There's one little golden nugget for the day. Who pays for this insurance? Covered by taxes, or do the banks have to pay anything? So the banks are paying in, especially with, I don't know about SIPC, with FDIC protection, the member banks pay into a pool of funds that are used for bailouts and emergency purposes, which in theory is what we used back in March when the banks came cratering down, or some of the banks came down. If it gets to a certain point, yes, you and I, the taxpayer, may be on the hook for something, right? Because those costs are going to get passed on to us. And let's be honest, if there's a $50 billion pool of money and all of a sudden a bunch more banks go down and we have to bail them out with that $50 billion pool, they're going to raise the amount of money that banks need to put into that pool, right? So if the banks are tapping their quote-unquote insurance to pay their customers that they can't pay, what do you think happens? You all know, if you get into an accident and you use your insurance, what happens to your premium cost? I think it'd be pretty clear understanding in my book that if the banks go under or have a problem and they need to tap that reserve pool of money from the FDIC, then all of a sudden they're going to start charging banks more money, and you and I know very well that's not going to be a cost to the banks. That will get passed through to me and you, the consumer, with a new fee here. It'll be the insurance protection fee. You have to pay, $2 a month to have your account insured. Watch. That will probably be something that happens here soon, is you'll notice something on your statement that says, oh, my Charles Schwab statement or my JP Morgan Chase, $1 a month fee for what? Oh, that's the FDIC insurance premium. And you're now going to be paying that premium. Watch. It's coming. I'm telling you. There you go. Good questions, Margaret. I had one other question, and then I'm going to dive into what happened in the markets today. I know you guys are eagerly waiting that one. And let's see. There was slides I prepared. FDIC audits these banks, I believe. FDIC does audit. They go back through and make sure that there's liquidity and make sure the banks are in stable condition. There's stress tests that they're put under, etc. But I have to put the skeptic's hat on. I look at this and go, I don't know if they're actually watching. I don't know if they're actually going through. I haven't seen any of the actual audit statements. I don't know what they're looking for. So in my severe skepticism, all things that are supposed to be quote unquote reported to me, I have to look at the job of the FDIC and say, I have to trust them, which is a really difficult thing for me to do with anything tied to the government, regulatory. That word trust is something that they have not earned, in my opinion. So yes, the FDIC is supposed to be doing that. However, do you believe them, Margaret? Now, obviously, I think it's in their best interest, right, to go and make sure that these banks are in a liquid position, they're capitalized correctly, they're not taking big risks. But for me, I'm not. I just don't trust them. Rob says there's a service fee at TradeStation. I don't know what the fee structure is at TradeStation, Rob. I haven't used them in a couple years now since they started charging me professional fees and being real jerks to me. So I was like, done with TradeStation. Close my accounts out. I can still get data, but they close my accounts, or I close my accounts out and put money to use in better place until they loosen up their cost and become so rigid. TradeStation is one of the most rigid platforms from compliance perspectives. Crazy how many accounts they would turn down. It's like, just open the accounts. All right, well, so let me go back to something we talked about on Friday's show. So I can wrap this one up quickly. We'll go to the overall markets, and I'll be done by another 15 minutes or so. Pepper says, one question I still have, to which you alluded, but on which I still need clarity. It sounds like you are checking options daily for opportunities, not weekly, even though you're selling them weekly. Is that correct? Yes. So I'm selling them monthly, weekly, daily. I'm selling them whatever I find opportunity on. So in general, what I would prefer to be doing is selling them on a monthly basis, right? 30 days out, less than 30 days, get 1% or more, very stress-free, and it's okay. The challenge with that is selling a put 30 days out, you're giving yourself 30 days worth of risk that security could just go wild and stop you out. Or not stop you out, but be put to you, and all of a sudden it just keeps on going down like Tesla started to do from last. So I do like the weekly option side of things, because now if I sell them on a Monday and I'm out on a Friday, I've got a 5-day window of time. Yes, a stock can go nuts in a 5-day window of time, but the odds are much less, right? The volatility, I think you'd all agree, the volatility in a 5-day window is probably much less than it is on a 30-day window. So if I find an opportunity, like today, I was looking, I got a bunch of capital I want to put to use. I didn't find anything that was really that appealing to me. I'm going to look tomorrow again. If I see something that does pose some potential, my first inclination is I'm going to look at Friday expiration. Because if I can get a nice cut of premium for the week, great. If not, I'll look out maybe what I get for the October, right? Or September 15th, excuse me. And after that, maybe what's the October going to look like, right? So I will look and see where the premium fits my risk tolerance. If it's something that moves rather slowly, maybe I will go out to October because I'll get more premium, but I also don't want to tie up my capital that long. If I find something that is just for the next couple of days, for the remainder of the week, great. I'm okay with that. I don't have a specific where I have to do. I do have 2 accounts, which is just 30-day expiration. I don't want to go any smaller than that because I don't want to spend more time than I need to. So I do. The options expire, I'll go and look for the day or an opportunity, within the next week that will last me for the next 30 days. That one. How do you know which ones are registered SIP? You can contact FINRA, I believe, gives you that information, or SIPC and FDIC directly. I believe there's a link there that says check your broker. There was one with FINRA, but I haven't done one with SIPC in a while. So, Pepper, hope I answered your question there. It's really wherever you find opportunity. And today, from a put selling perspective, there really wasn't much out there that looked appealing to me at all today. Anything that I was like, ooh, good opportunity, nothing looked good. If you look here at my list of indexes, so this is the list of indexes I like to look at. I like to generally go with the spider funds, utilities and healthcare and consumer staples, those, because they're diversified. Only one was down to that was utilities and was barely down. So, if I'm looking to open new put positions, I want pain. I was kind of hoping we'd see a big sell-off today and people screaming for the exits. Great. I'll sell you some puts. Have at it. Buy my puts from me. But instead, I got nothing today, so didn't really see any opportunities. I will wait. Now, on that note, you guys, will keep you abreast of what's going on in the Fortinet situation. Here's Fortinet today. I sold the options expiring this Friday. 59.50. So let me put a line up there at 59.50. Oh, what that is, 59.50. I got 60 cents worth of premium. So I'm literally getting an extra 1% on my investment for the week. As long as it stays, if it stays below there, great. If it rallies up above it, it'll take my shares away at 59.50. Remember, my strike price was 58, which means I made $1.50 on the underlier plus all the premium I collected. And I'll give you the ultimate, when we're done with this trade, how it panned out on the rate of return on the premium I collected, plus the overall rate of return for the underlying. Anyway, that's the only thing I did today was sell calls against my Fortinet position at 59.50. Those expire on Friday. We will see how that pans out. I wanted to make sure we got to that one before we wrapped up the show. The full faith and credit of the United States government. Yeah, there you go. Are short-term treasuries covered under SIPC or FDIC? No, they are not. No, they're not. So treasuries, T-bills, government bonds, no government bonds are protected under SIPC because, as Margaret says, they're guaranteed by the full faith of the American government. So if there's no money to pay you the interest premium for the bonds that you purchase from the U.S. government, they'll just print more money to pay you the premium that you should be earning. Oh, doesn't that sound like a Ponzi scheme? There's no money there, so we'll just print more money to pay you the money that we owe you, and then we'll encourage you to buy more of the bad money that we don't have so we can create this cycle all over. So, yeah, Martin Luther, Margaret is right. It's backed by the full faith of the U.S. government. Yeah, love that one. Okay, I think that's going to do it for that section. Let me go out real quick and look at your earnings calendar, your economic calendar, because as you know, the economic calendar really doesn't start till Wednesday as far as exciting stuff. We do have a couple exciting earnings ones. Let me get to that here in just a second. There it is. So here's our earnings calendar for today. And there's really nothing happened today. You have 101 companies reporting earnings tomorrow. I notice NEO. That was today. Market cap. Huh. Hey, I thought NEO was oh, all right, what is my calendar's all messed up. Okay, so it is tomorrow. It just somehow switched on me. So tomorrow you have NEO, you have Hewlett Packard, Best Buy. Oh, I hate Best Buy. See what Best Buy's been doing. Best Buy is a one that just, I almost want to put it on my trading plan. I can never trade the stock again. I think I told you guys the story, but back in 2013, scroll over because I can tell you. Yep, there it is. There it is, guys. Right about in here, I started shorting. I know the podcasters, I know you can't see this, so I will just read it out to you. But back in, I don't remember the exact date, but it was like July, August of 2013, I was loading up on the November puts. Actually, sorry, it was the December puts. Loaded up on the December puts for Best Buy. And as you notice right here, I'll put a vertical line where the November or December puts expired. So vertical line, December, third week is going to be right around there. All right. So that's when those puts expired on me. And that was a six-figure plus loss on options. I had a lot of Best Buy options, and I just let them expire worthless. Anyway, if I just bought the January ones, here, go out to the January options, I would have gotten out after that earnings announcement, and they dropped over 50%. And shoulda, coulda, woulda, right? But yeah, this one's just is a sore subject for me, my Best Buy trade. And it was a stupid trade because why would you ever short any company going into the holiday season? Just stupidity on my part in hindsight, especially somebody like Best Buy who does fairly well during the holiday season. After that I'd want to. Anyway, Best Buy reports earnings tomorrow. You've got NEOs. Let me bring up some more charts here for you guys. Go back to our NIO. This one has been having a rough go of it recently. You know, back in 2020 when I started doing this show, it was ripping. Absolutely ripping from, $5-10 and ripping all the way up to over $65. Now we're down at around $11. There's more and more talk about more Chinese and Asian electric vehicle companies coming onto the market, which, right? Competition, more selection, hopefully better quality as we go forward. But they're reporting earnings on tomorrow. I will not be trading that announcement. Now, what else did I have on the earnings front for you? That was at Hewlett Packard, Best Buy, and then NEO were the main three. As far as Forex or factory, that's where I'm going to pull up your economic data for tomorrow. Kind of light. Economic data for tomorrow is rather light. It all really starts to go off on Wednesday, which I'll show you. I'll show you Wednesday now. And tomorrow I'm probably going to, we're going to talk a lot about bonds with Bill Addis, but you have JOLTS job openings and CB consumer confidence numbers for the U.S. You have HPI data. You have the Case-Shiller Composite 20 Home Price Index data. This one I think is going to be very important. So I'll zoom in here real quick so you guys can see the graphic. But as you know, the S&P Case-Shiller Composite 20 Home Price Index represents the price of homes in 20 major metropolitan areas of the states. Here is the chart of it. Wah, wah. It's been pretty ugly. Now, been down below zero for 3 consecutive months. Now, they're expecting to be negative 1.5, which is still negative, but starting to improve a little bit. Back here and go all the way back into the 2008 housing crisis. This might be the start of something big here, or it might just be a little dip down below. We don't know yet, so I think it's important to keep your eye on that Case-Shiller Composite 20 Home Price Index number. That's your main economic announcements, your earnings calendar. You got a little bit of SIPC, and now we got to just real quickly run through your top 10, just so we can see what happened out there today. As I'm sure most of you know what happened, markets were actually okay. Here is your 10-year. See the red candle here forming for today's session. So nothing dramatic there. Was certainly a nice down day for the 10-year, but hasn't really made any downtrend pieces. Kind of holding on to this level right around 4.2%. Dollar index on the day. Little bit of hesitation and rollover after that hesitation pattern on Friday. You see that spinning top formation with the topping tail and bottoming tail right there. If there is a pullback on this dollar index, I think you'll most likely see it come right down to this 103.50 mark, which is kind of where it consolidated for the better part of 6 days before ripping up. So maybe a little bit of a retest there. Bitcoin, call it unchanged. I guess flat is exciting for Bitcoin. So here we're at 26,090. Again, I think all eyes are really just waiting on BlackRock spot Bitcoin ETF announcement. Crude oil, 0.34% to the upside, spinning top formation. That means indecision. From that pattern right there, I would have to put myself in the camp of downside tomorrow on crude oil, just because going back into August 9th, it's been making a little bit of a small downtrend of lower lows, lower highs. So typically when you have that retracement into an overhead supply, hesitate and come back down. So my bullish or bearishness for tomorrow on crude oil. Here's gold. Gold indecision again, sideways, topping, bottoming tail, small real body. It was up 0.36% in the day to 1946. And then our podium was a clean sweep from the equity indexes. S&P 500 up 0.63% to 440.42. Got it right. 4,440 quarter is where it's at right now. Technically, though, you look at it, while it's nice to have 2 consecutive days of a bounce, there's no real clear uptrend, downtrend, support, resistance. None of that really comes into play at this moment in time yet for the S&P. Top 2, NASDAQ 100, 0.76% gain. Same story as the S&P. There's nothing here that really says I'm really bullish, I'm really bearish. It's kind of a meh kind of moment there. And last one, Russell 2000, which is a little bit better because at least the range is somewhat even on it. Got nice sideways consolidation for the Russell. Really looking for a breakout above today's highs would be good above 1884 or potentially challenge these lows that we saw back around 1885. Lisa says, I was watching a stock, VFS Auto Company. Yeah, that's, let's go VFS. The new one, VinFast, right? And I tell you what, I'm looking at VinFast going, I want to short fast, but I just don't have the intestinal fortitude to do so. This thing is so driven on hype and expectations. Now, could it be huge? Absolutely. Could it be massive? Absolutely. Notice what happened. Okay, so what you're looking at here is a SPAC, right? This is another SPAC that started back in September of 2021. And it went sideways for a while. They said they made this deal with VinFast Auto, spiked up, and all of a sudden now it's ripping. Let's go to some other SPACs. See a similar picture here. Would you guys agree with me if I said, does this chart look exactly like VinFast right here? That looked just like the chart we just looked at. It went from $10 up to 64. VFS. I mean, $10 up to 90. Same chart. Same damn chart. You could go to, Nikola was actually a SPAC back then too. And look what happened to, here's Nikola. That chart looked the same. I mean, this is almost identical, guys. It was, when they made the announcement, it spiked, it sold off a little bit, and then all of a sudden ripped all the way up to $90, and now it's trading at $1.24. So at some point, if history is any indication from looking at these car companies like this, VFS is one of those ones like, maybe it's about buying some leaps on it, selling some leaps, going long puts on VinFast, but you're probably not going to find any options on this bad boy, at least nothing that's liquid because the volume is probably pretty low. Let me check the volume here. Volume, actually pretty liquid. They did 12 million today. Before we take off, let's go look at real quick at VFS. I just want to see what's the PE ratio. There's probably no earnings, so it's going to have no PE ratio. Valuation of the VFS is going to be off the charts, ridiculous. But I'm curious to see what the market capitalization is. I was reading something that's like it's got a market capitalization that's bigger than Ford and Chevy and VFS. That's VinFast. Let's go look at that market capitalization. Market cap, $191 billion. They're losing $1.38 per share, and they got a $191 billion market cap. Let's go check out old Ford. Ford has a $42 billion market cap. So this thing is over 4 times as big as Ford, who's got cars, establishment all over the United States. I don't know. I look at this as a pipe dream. I think of this stuff, I'm like, man, how can I just short everything I got? But I just don't want to take that chance because this thing could gap up to 100 and 150 and 200. But at some point, I'll say it again, like I said with Nikola, and I said it with GameStop, and I said with AMC, those super sharp rallies that you're seeing, at some point, via VFS will probably within the next, I'll say 60 days, it'll be below 30 bucks. How about that? I want to put a little mark on the screen. 60 days below 30 bucks. So what's today is August, September, so October 28th. Below. Think I'm being overly aggressive? Think I'm right on? What do you guys think? Think nuts? I might even be a little too high. I'm probably gonna be lower than that. Line right here. Friday, October 27th. I'm gonna put a line at $30. That is my target. There you go, 30. Even that, I think, is being generous. And if just so for you mathematicians out there, from current valuations to that line, that would be a decline of 63, call it 64%. Easily doable in a period of hype with the have. I thought the same thing, but I wouldn't even buy puts. Too scared, yeah. I don't know, Dave. I might look at it tomorrow because that's just a ridiculous chart. And, you know, it's funny that we looked at Nikola, same chart. We looked at Lucid, same chart. You know, a SPAC that had its huge boom. And to think that this thing has a valuation that's almost 5 times the size of Ford. Got factories, employees all over the United States, and this thing barely even starting. I don't know. Seems a bit crazy to me. Anyway, that's going to do it for me for today, guys. I will have Bill Addis on the program tomorrow. If you have something that you would like me to discuss, as today's discussion was driven by viewer comments, I welcome it. So, Ricardo, thank you very much for your question about FDIC, SIPC insurance, what types of protection are out there, IRAs, 401ks. Well, that's not generally the focus of this show. It's nice to spread topics around a little bit, be more informed about the broader financial market. So thank you, Ricardo, for that one. If you guys have something you want me to cover, just send it in. TraderMerlin@gmail.com or down below any of the YouTube videos, and I will get to those on future shows. Tomorrow, it's all about Bill Addis, bonds, interest rates. So if you have a question for Bill, send it on in. I will see you guys tomorrow.